You've been told the United States runs on taxes, trade, and growth, but that's only part of the truth. The real engine runs on debt, not the kind you owe on a credit card, but the kind governments create from thin air and then promise to repay with money they haven't earned yet. This is the story of how the United States mastered the bond trick, built an empire out of IOUs, and learned to buy its own debt without blinking. Start with a simple question. When the US government spends more than it earns, where does the extra money come from? It doesn't have a giant savings account. It issues bonds. Treasury bonds, bills, and notes or promises. Each one says, lend us money now, and we'll pay you back later with interest. Investors buy them, thinking they're the safest bet on earth. But here's where it gets strange. The biggest buyer isn't China or Japan. It's the United States itself. Through its central bank, the Federal Reserve, the US has turned borrowing into a self-financing loop. To see how this began, you have to rewind to 1913. The Federal Reserve was born that year, right before World War I. Before then, money was tied to gold. You could trade a dollar for a fixed weight of it. That limited how much money the government could print. War broke that system. The US needed to fund armies, build weapons, and lend to allies. It couldn't do that with gold in short supply. So it issued bonds and let the Fed buy them. The Fed created dollars to pay for those bonds, and the government used those dollars to fight the war. When the guns fell silent, the habit stuck. The bond market became America's silent weapon. In simple terms, here's how the trick works. The Treasury issues bonds. Investors, including banks and pension funds, buy them. Those bonds end up as collateral in the financial system. The Federal Reserve then enters the scene, buying some of those bonds from investors. It pays with money created electronically. That new money flows back into the economy, boosting liquidity and credit. On paper, everything looks stable. But what's really happened is that the government has borrowed from itself. The left hand writes the IOU, and the right hand accepts it as payment. This cycle didn't always exist at the scale you see today. In the 1940s, wartime debt reached levels never seen before. The Fed stepped in to keep interest rates low so the government could keep borrowing cheaply. After the war, inflation picked up. The Fed and Treasury struck a deal. The Fed would operate independently, but it would always be ready to step in during emergencies. That agreement laid the foundation for modern monetary control. Fast forward to 1971. President Nixon cut the final link between the dollar and gold. From that day, the dollar was backed only by faith. The government could print or borrow as much as needed. The bond market exploded. Bonds were no longer promises to pay in gold. They were promises to pay in more dollars, which the government could always create. Debt lost its ceiling. The Fed gained its power. Through the 1980s and 1990s, this bond-based system became the invisible architecture of global finance. Every bank, every country, and every investor used U.S. treasuries as their foundation. Why? Because everyone trusted the U.S. to pay its debts. But this trust allowed the government to stretch its limits. By 2008, total U.S. debt passed $10 trillion. Then came the crisis. The housing market collapsed, banks froze, and the financial system nearly stopped. The Fed launched quantitative easing, or QE. It began buying massive amounts of government bonds, trillions of dollars worth. Think of QE as the bond trick on steroids. The Fed didn't collect taxes or sell goods. It simply created money and used it to buy debt. This made bond prices rise and interest rates fall. Lower rates meant cheaper borrowing for the government, businesses, and households. It was supposed to save the economy. It worked, temporarily. But it also created a world where debt never stopped growing. Every time growth slowed, more bonds were issued. Every time the market trembled, the Fed bought more. Today, the numbers are staggering. The U.S. owes over $34 trillion, whose interest payments alone are one of the largest government expenses. Yet every auction finds buyers. How? Because the system has become self-reinforcing. The Fed buys when no one else does. It sets rates near zero when panic strikes. It assures investors that treasuries are risk-free, that confidence keeps demand alive. But let's pause. Why should a government buy its own debt? Isn't that circular logic? It sounds like borrowing from yourself. In a way, it is. But the trick lies in perception. To the public, bonds look like savings instruments. To the Fed, they're policy tools. By creating demand for bonds, the Fed controls interest rates. Low rates make debt cheaper. Cheaper debt allows more spending. More spending fuels growth, at least in the short term. It's like pulling yourself up by your own shoelaces. This bond-based model also gives the U.S. a unique advantage globally. When foreign nations need a safe place for their reserves, they buy U.S. bonds. Every purchase strengthens the dollar. Every dollar spent abroad eventually finds its way back into treasury markets. This is why the U.S. can run deficits year after year without losing trust. The dollar isn't just national currency, it's global money. Yet every trick has a cost. Buying your own debt inflates your balance sheet. The Fed ES assets have ballooned from under $1 trillion in 2007 to over $8 trillion today. That balance is filled mostly with government bonds. When interest rates rise, the value of those bonds falls. Losses pile up. Meanwhile, the Treasury must issue even more bonds to cover higher interest payments. It's a spiral, one that looks stable only because everyone keeps believing in it. If belief ever cracks, the system shakes. That's why every Federal Reserve chair speaks carefully. Markets hang on every word. A hint of tightening and bond yields surge. A promise of easing, and they fall. The illusion of control depends on confidence. Break that, and the bond trick stops working. We've seen glimpses of that before. In 2013, when the Fed hinted at reducing QE, markets panicked. Yields jumped. Stocks dipped. The Fed backtracked. In 2020, the pandemic hit, and the Fed flooded markets with liquidity again. Trillions more. Each rescue made the trick harder to unwind. Once a system learns to depend on self-financed debt, withdrawal becomes dangerous. The question now is simple but unsettling. How long can this continue? Can a nation keep buying its own promises forever? Or does every trick, no matter how clever, run out of magic? The next section takes this illusion apart. You'll see who profits from this cycle, how it shifts wealth from workers to investors, and why each round of bond buying deepens the divide between the financial world and the real one. Let's strip the illusion. The bond market looks clean, safe, and rational, but underneath, it's a transfer machine. Every time the U.S. issues debt and the Fed steps in to buy it, wealth quietly moves upward. Investors in large institutions gain first access to new money. They use it to buy assets, stocks, real estate, commodities, before prices rise. Ordinary people see inflation later when those prices have already climbed. The bond trick doesn't just finance government spending, it reshapes who gets rich. This cycle creates a powerful alliance between Wall Street and Washington. When the Treasury borrows, it needs buyers. Banks act as middlemen, taking a small cut. The Fed then buys from those same banks, adding liquidity that flows into markets. Everyone wins, except the public paying higher prices. The more debt circulates, the more the system depends on expansion. Shrink it, and credit tightens. Expand it, and inflation bites. There's no easy off-ramp. Think about what happens during every crisis. In 2008, banks collapsed under toxic assets. The Fed bought bonds and mortgage-backed securities, injecting trillions. In 2020, when the pandemic halted trade and jobs vanished, the same playbook returned. New bonds, new money. Each round rescued asset prices. The stock market soared while wages stagnated. By 2021, U.S. billionaires had gained over $2 trillion in net worth. Workers faced higher rent, food costs, and healthcare bills. The trick kept the system afloat, but it tilted the board. Bond buying also changes how politicians behave. In a normal world, debt would be limited by what voters tolerate. Raise taxes or cut programs, and the public reacts. But when borrowing looks painless, discipline disappears. The bond trick lets lawmakers promise benefits without immediate cost. Roads, subsidies, wars, all charged to tomorrow. Deficits fade from debate because the Fed always finds a way to absorb them. The cost is hidden in slow motion. As the Fed buys bonds, it expands its balance sheet. The new money filters through banks before reaching the real economy. That lag favors capital over labor. Asset owners see gains first. Wage earners see devalued dollars later. Over decades, this compounds inequality. The top 10% hold most financial assets, so they reap the upside. The bottom 90% hold cash, which erodes. This isn't accidental, it's structural. To understand how this feedback loop evolved, look at how the bond market grew. In 1980, U.S. debt was under $1 trillion. By 2000, it was $5 trillion. After 2008, it doubled again. Each jump followed a crisis. Every solution was the same: issue more bonds. Politicians promised growth would outpace borrowing. It never did. The ratio of debt to GDP climbed relentlessly. The U.S. now owes more than its entire yearly output. So why hasn't it collapsed? Because debt denominated in your own currency is different. The U.S. prints the world's reserve money. It never has to default. It can always pay by creating new dollars. But that safety breeds risk. Confidence is everything. If foreign buyers ever doubt repayment, they demand higher yields. Rising yields mean higher interest costs, which force more borrowing. The trick becomes a treadmill. China once held over $1 trillion in treasuries. Japan holds about the same, but both have trimmed their positions. Foreign demand is fading. Domestic buyers fill the gap, led by the Fed and U.S. institutions. When the Fed pulls back, markets stumble. When it returns, rallies resume. The entire global economy now reacts to Fed bond purchases like a patient to medicine. Miss a dose, and symptoms appear. This dependence shows in every market swing. When yields spike, mortgage rates jump, housing slows, and stocks fall, the Fed steps in to buy bonds, pushing yields down. Borrowing costs drop, and speculation returns. The trick stabilizes prices, but disconnects them from reality. A house worth $300,000 rises to $600,000, not because materials doubled, but because cheap credit inflates demand. When money is free, everything else looks expensive. This credit-driven world creates moral hazards. Banks expect rescues. Corporations expect bailouts. Governments expect the Fed to clean up fiscal excess. Each expectation grows stronger with every intervention. The system E as health becomes measured not by productivity or innovation, but by how much debt it can absorb. Critics argue the bond trick has turned capitalism into managed finance. Market signals, interest rates, bond yields, risk premiums, no longer reflect true conditions. They reflect central bank policy. The Fed sets the rhythm, investors follow. That makes real price discovery impossible. If yields are capped artificially, bad borrowers survive. Zombie firms linger, draining capital that could build new industries. This distortion extends beyond borders. Emerging markets peg their currencies to the dollar or hold treasuries as reserves. When the Fed prints, liquidity floods in. When it tightens, money rushes out, crashing weaker economies. The bond trick becomes a global lever, shifting pain outward. Nations that don't control their own currency feel its pressure first. Look at Latin America in the 1980s. Rising U.S. rates caused debt crises across the region. In 2013, a hint of Fed tapering sent capital fleeing from Turkey, Brazil, and India. Every adjustment in U.S. policy ripples worldwide because every economy plugs into the dollar system. Treasuries are the anchor. When the anchor moves, all ships sway. Domestically, this dependence turns every Fed decision into politics. The central bank is supposed to be independent, but its moves decide elections. High rates slow hiring and housing. Low rates inflate markets. Every president wants low rates before a vote. Every investor bets on the Fed's mood. Policy becomes theater. Meanwhile, the public narrative stays simple. News headlines talk about raising the debt ceiling as if it's a budgeting issue. In reality, it's a formality. Congress authorizes spending first, then debates how to label the debt later. The ceiling rises every time because the alternative, default, would break global confidence. So the trick continues, each round larger than before. Some economists defend this as necessary. They argue modern economies need constant liquidity. Others warn it's unsustainable. The truth lies between. The bond trick keeps the system alive, but it weakens its foundations. You can't expand debt faster than growth forever. Sooner or later, interest outpaces income. Then, every dollar of new borrowing pays for old interest. That's when the trick becomes a trap. We're approaching that zone. Interest costs now exceed $1 trillion annually. That's more than the U.S. spends on defense. Yet cutting spending or raising taxes risks recession. The path of least resistance is more bonds, more Fed buying, more illusion. The longer it runs, the harder it stops. In the next section, we'll track where this path leads, how endless debt changes global power, why de-dollarization movements are rising, and what happens when faith in the bond trick fades. The bond trick gave the U.S. more than a financing tool. It built a global empire. Every country that trades in dollars, saves in treasuries, or settles oil deals in greenbacks reinforces that system. The U.S. doesn't need colonies. It has the bond market. When foreign central banks buy treasuries, they fund American spending. Military bases, imports, and foreign aid, all supported by global demand for U.S. debt. It's a quiet form of tribute. Here's how it works. Nations sell goods to the U.S. They earn dollars. Instead of holding cash, they buy treasuries for safety. The Treasury uses that money to cover deficits. Dollars flow out to buy imports, then return as debt purchases. The loop keeps turning. The world exports goods. The U.S. exports paper. As long as everyone trusts the paper, the system hums. That trust is the real currency. But cracks are forming. In recent years, countries have started looking for alternatives. China pushes the yuan for trade. Russia shifts to gold and regional currencies. The BRICS bloc talks about a shared reserve asset. None of these have dethroned the dollar yet, but the intent is clear. They want to escape the cycle. Why? Because U.S. monetary policy exports instability. When the Fed prints to buy bonds, global inflation rises. When it tightens, global liquidity dries up. Other nations pay for choices made in Washington. For decades, they accepted that cost because U.S. bonds were safe. That's changing. Political gridlock has turned debt ceiling debates into global risks. Credit rating agencies have downgraded U.S. debt before. Foreign holders watch these standoffs with unease. If confidence ever breaks, they will diversify faster. That would push yields higher, forcing the Fed to intervene again. The bond trick would spin faster, not slower. There's also a geopolitical angle. U.S. sanctions use the dollar system as a weapon, freezing reserves, cutting access to SWIFT, blocking transactions, all leverage the bond network. Each use of that weapon signals to others that they need an escape route. You can't rely on a system that might turn against you. That's why gold reserves are rising in many emerging markets. They're hedging against dollar dominance. Domestically, the bond trick is changing expectations. People no longer see debt as a warning. It's become normal. Every crisis leads to more borrowing. Every rescue adds trillions. Politicians campaign on spending promises, knowing the Fed will smooth the path. Fiscal rules sound outdated when the printing press always runs. The result is complacency. Inflation becomes the only visible limit, and even that fades in memory when markets recover. Yet inflation is the quiet tax. When the Fed buys bonds with new money, prices rise. Not instantly, but gradually. Wages lag behind. Savers lose purchasing power. The government repays old debt in cheaper dollars. It's a soft default, one that hides in plain sight. Those who understand this shift assets into real estate, equities, or commodities. Those who don't watch their savings erode. The bond trick also breeds fragility. Every expansion cycle lifts asset prices, fueling confidence. But when rates rise to fight inflation, bond values drop. The Fed faces losses on its balance sheet. Banks holding treasuries face mark-to-market hits. In 2023, several regional banks failed because rising yields crushed their bond portfolios. The safest asset turned toxic when policy reversed. That risk doesn't vanish. It waits for the next turn. Some call this financial repression. Governments keep rates below inflation to manage debt costs. Savers lose, debtors gain. Over time, this transfers wealth to the state and financial elite. It worked after World War II when demographics and growth were strong. Today, with aging populations and slower productivity, it's riskier. Low rates encourage speculation, not investment. Debt piles up faster than income. What comes next depends on one variable: belief. As long as markets believe U.S. bonds are safe, yields stay manageable. If belief falters, rates climb. High rates increase interest costs, forcing new borrowing. That loop is sustainable only while the Fed buys enough to suppress yields. But constant intervention weakens the dollar's credibility. The system survives on confidence in the very trick it uses. Imagine a scenario where inflation resurges and foreign buyers retreat. The Fed faces a choice: support the bond market by printing more, risking higher inflation, or step back, letting yields soar and markets fall. Either option hurts. That's the corner of self-financed debt. Every escape leads back to the same door. Some analysts propose fiscal reforms, balanced budgets, spending caps, entitlement cuts. Others suggest modern monetary theory, where deficits don't matter until inflation bites. Both assume political discipline that rarely exists. The easier route is always to borrow. Bonds smooth pain, delay decisions, and make every problem tomorrow's problem. The deeper issue is cultural. Debt has become identity. From personal credit to national finance, borrowing fuels consumption and growth. Breaking that cycle means accepting slower gains and fewer promises. Few leaders want to sell restraint. Few voters reward it. The bond trick thrives because it flatters both sides. So where does this leave you? You live in a world priced by debt. Every mortgage rate, stock valuation, and job number ties back to Treasury yields. Understanding the bond trick isn't abstract. It's practical. When rates rise, assets reprice. When the Fed buys, bubbles grow. And when it pauses, liquidity dries up. Watch those moves more than political speeches. They decide the future. If history is a guide, no empire sustains endless borrowing. Rome clipped its coins. Britain debased its pound. Each believed its currency would stay supreme. The U.S. holds the same faith today, but every trick works only while people believe in it. Confidence builds slowly and collapses fast. The lesson isn't panic, it's awareness. The bond trick made the modern world, its wealth, its markets, its comforts. But it also built a tower leaning on promises. If you understand how those promises work, you can prepare when they bend. Because one day, the